Hello friends, welcome to the show Bottoms Up Research with Harshit Toshniwal. This video we are going to do a deep dive on hospital sector. We are also going to cover 10 of its largest listed names. It's a 7-part video, so for best understanding would request you all to have a look at all the 7. And one additional thing, if you find this video useful, then please like it, subscribe it and share it with more people. Let us start now. Hi, so in the 5th part of the hospitals industry primer, we are going to discuss about few other hospitals. In the first 4 parts, what we covered is the hospital basics, and we also covered in the part 4 about the NCR based hospitals like Max, Medanta and Artemis. Right now what we are going to look at is 4 more hospitals. In सबकी presence is relatively more diversified. When I say diversified, I don't mean that they are very much present all across India, but the point is that they have diversified from the very initial point of establishment for most of these hospitals. Say for example, Narayana started in Karnataka. इनका बेस कर्नाटका था. Apollo Hospitals, their original base was in Chennai in 1983. KIMS started from Hyderabad region, Sikandarabad region in Hyderabad, Telangana, and Fortis, for example, started more from Punjab, NCR, Delhi region. But over time and over years, all of these players have expanded themselves into the various other regions. Could be east, west, north, south, etc. But now most of them have much more diversified presence from what they started off earlier. So let's look at Fortis hospitals to start with, right? Fortis today has around has an overall bed capacity of roughly around 4,300 to 4,400 at an overall level. For a long time they have not expanded a lot, so which is why most of these hospitals are mature hospitals in terms of their age profile. Now an important thing in case of Fortis is कि अगर हम इनकी landscape को देखते हैं at a India level, then they are very well diversified. Delhi NCR forms around 35 to 36% of their overall revenue. Punjab forms around 15% of their overall beds. Mumbai forms around 15% of their overall beds. Karnataka forms around 13% of their overall beds. Similarly, West Bengal, Rajasthan, Tamil Nadu, Chhattisgarh are the other places where they are present to the extent of 6 to 7% of the overall beds. So first is their truly diversified presence across most of the parts of the country, even though they are more dominant into the north region and south region, some in the west region. And the second part, which is a good part about Fortis, is that so they don't have any single hospital which is more than 15% of the overall revenue, right? Their largest contributor to their revenue is FMRI Hospital, which is there in NCR Gurgaon. That's contributes around 566 crore to the overall revenue of 42,644 crore. So which is why none of the hospital 15% से ज़्यादा कोई नहीं contribute करता है. The other part is that इनकी कोई भी hospital कोई बहुत मेगा साइज्ड हॉस्पिटल नहीं है. फॉर एग्जाम्पल वी सॉ इन मेदांता दे हैव 1,000 बेड मेड सिटी हॉस्पिटल. We'll see in case of KIMS they have a 1,000 bed hospital at Sikandarabad, which is a large hospital to that extent. For them the maximum bed capacity which they have in one single hospital is Mohali, Punjab, which has 350 bed hospital. But now otherwise all their top 10 hospital range between around 200 to 350 bed facilities. That is the second interesting part about Fortis hospitals. The third interesting part about Fortis hospital is their margin mix. It's a data which they give. So for them, 4 of their hospitals are more than 25% EBITDA margin. These hospitals are Mohali in Punjab, the BG Road Bangalore Hospital, and Anandpur in Calcutta. 2 of their hospitals, Faridabad and Ludhiana, they are there in the 20 to 25% margin bracket, but around 5 of their hospitals are ones with less than 10% margin, and one of their hospital is between 10 to 15% margin. So the thing is that when I look at FY22, they have 6 hospitals which are less than 15% margin despite being mature hospitals, which is where I think there is room for them to improve the overall margin profile of the business. Their hospital margin is currently around 17 to 15 to 17%. This number can go up to around 20 to 22% range over time, gradually, as they improve their margin profile of the bottom bucket of those hospitals. That's the third part about Fortis. Fourth part is their expansion plans in FY23 and 24. There are no major expansion to say, so there are 100 beds in Mumbai and 60 beds in Faridabad, which is going to come. But in FY25-26, they have major hospital beds planned. Around 800 beds are going to come in that particular 2 years, of which there are going to be 200 beds into 4 hospitals. All of them are going to be brownfield in nature. So these hospitals are going to come up in their FMRI unit, in their Noida unit, in their Shalimar Bagh Hospital in Delhi, and in their BG Road Hospital in Bangalore. So all of these are already they have very good occupancy levels. So it's going to be brownfield and it's going to be easy to scale up. So this 800 bed capacity is something which will go to see in 25-26. And since there are no major greenfield planned in the recent years, the advantage for Fortis is that there is genuine scope of improving the overall margin from 17-18% in hospital to more like a 20% number. It just needs a consistent execution. And fifth part about Fortis's business is that around 20% of their overall revenue comes from diagnostics. SRL Diagnostic is the one where they own 57%. It's one of the well-recognized diagnostic chains. In FY22, we saw its revenue shoot up to around 1400 crore and the business clocking 30% margin, but that was one-off. But when we look at, say for example, a normal year, it is going to be around 20% of the revenue and 20% margin profile for this business. It should grow at 15 to 20% on a more consistent basis, similar to the other diagnostic story. So this is in brief about Fortis, the landscape. In Fortis, what is also important to understand is the history behind it, and for that we are going to look at things, 2 parts in a particular timeline. First is the Ranbaxy and Daiichi Sankyo case, and the second part is where we are going to look at Fortis history itself. So let us understand that Ranbaxy Laboratories was one of the largest generic drug makers in 2000s. This Ranbaxy Laboratories was actually founded by someone else, but Bhai Mohan Singh bought it in around 1980s. And by 2000 it was one of the largest generic drug maker. But again, when we look at the year 2003-4, there were allegations that Ranbaxy was faking the efficiency of and the safety of its drug. It was a whistleblower complaint, but not much attention was paid to that. And simultaneously, in this period, the business was run by the grandsons of Bhai Mohan Singh brothers. So in 2001, they started Fortis Hospital. They always had though they had a very good business of drug making in Ranbaxy, they always had the aspiration to start hospitals. So they started Fortis Hospitals. It met initial success. They acquired Escorts Heart Hospital in 2005. They acquired Vocart in 2008. So what we see is Fortis today is an acquisition of 3 to 4 hospitals. And to that extent, they wanted to monetize their Ranbaxy business to put up more investments into the hospital business. So in 2008, they sold 34% stake in Ranbaxy to a Japanese major company, Daiichi Sankyo, for $2.4 billion and used that amount to invest in Fortis Hospitals. But what happened is that the allegations made in 2003 actually came true, and by 2012-13, the Ranbaxy, because of all the allegations against Ranbaxy had to pay a large financial penalty of around $500 million. Now, since Daiichi was the owner, he was the one who paid those financial penalties. But they took the Singh brothers to court on the grounds that they knew a lot of the efficacy faking, etc., but they failed to inform them at the time of transaction, and the court also took their matter very seriously. Simultaneously, in 2018, there were fraud allegations on Singh brother of 400 crore siphoning from Fortis Hospital. They had opened up an NBFC known as Religare, and again there were claims of fund siphoning of around 2400 crore from the NBFC. So a lot of the Fortis shares was actually pledged with the bank. So what they decided is that they wanted to, the lenders took the Fortis shares that was pledged by the Singh brothers and they offered it for sale. IHH is a global healthcare hospital brand. He came up and offered to buy 31% stake in Fortis for $1.1 billion and was ready to become the new promoter. So which is what banks accepted the offer, and that is how Fortis ownership was transferred from Singh brothers to IHH. In the meantime, what happened is that Daiichi Sankyo in 2016 again asked the court that they actually questioned the deal itself, saying that Singh brothers have not yet repaid the $500 million which they had to pay, and this was under question by the court. And they wanted the deal to be stopped because they wanted that Fortis is a cash generating asset for the Singh brothers. He wanted to use the Fortis cash flows to allow him to repay that penalty amount which he had to pay. So that matter remained in the court, and it remains in the court as a problem. When did the problem arise is that when IHH brought the Fortis Hospital business, they also appointed the CEO in 2019, Dr. Ashutosh Raghuvanshi. He came from Narayana after having 18 years of experience. But at the per SEBI rules, if you buy 30%, more than 25% in any company, become the promoter, you will have to do an open offer to buy another 26% shares. When IHH was about to make that offer, it is then when Daiichi challenged the deal seeking compensation before that went through. So Supreme Court in December 2018 put a hold on the open offer, and that open offer of 26% which is to be made by the IHH group still holds pending. And this is one of the most it has been a long case, last 4 to 4.5 years that this case has dragged, and I think this is one of the overhang which whenever gets clear will lead to a meaningful re-rating in Fortis. When I look at the Fortis numbers, obviously I think their pharmacy business is going to grow at 15 to 20%. In terms of their hospital beds, not much of the capacity addition is happening between 20 to 24. A lot of it is going to happen in 25 to 26 period. So not much is getting built by FY24. At ARPOB level, I'm giving them an increase of 7 to 9%. The reason being that since there are not much new capacities, they will have the ability to improve the payer mix in the existing hospitals. At the same point of time, I am building a better occupancy of around 70%, vis-a-vis 60% where 63% in 22. They are near to that number at this point of time with gradual increase. And overall, in terms of EBITDA margin, I think that there is a lot of room for them to improve the margin profile, especially the weaker 6 hospitals which have less than 15% margin. So to that extent, I'm building a pre-Ind AS margin of improvement of around 200 basis points over 22 to 24. With that, I think on a FY24 EBITDA, Fortis can do around 1500 crore EBITDA. At the current price, it trades at around 20 times EBITDA, 33 times earnings on 23, and 16 times EBITDA and 26 times PE on FY24 earnings, which is a very reasonable valuation in this particular sector. So when I look at Fortis, I think it is showing a lot of positive signs of turnaround. Q1 and Q2 results were the first few signs. There was also a lot of confidence in management regarding the outcome of the legal issues. I sense is that it's a long case and IHH has been investing in the business for a very long time. They were not able to infuse capital, which prevented Fortis from doing any large capacity expansion, but whatever they plan over FY23 to 26, the brownfield one, that is something which if their internal accruals will be sufficient to do that. So once and whenever this clearance on legal issue happens, it is going to be a positive development. Since there is lower visibility of capacity growth, it is actually linked to the legal issue getting cleared. Once that gets cleared, I think Fortis, again, it's not going to be a negative point anymore. It has a very strong brand. It is geographically very well diversified. When we look at Fortis, they are one of those hospitals that is present across all the regions, and it's not more than 15% of the revenue comes from any single hospital. So overall, Fortis is something which I find very attractive from an investment point of view. Yes, there is one uncertainty regarding the legal problem, but I think whenever that gets sorted, it has a lot of upside left in it. Let's look at Narayana hospitals. Now, for Narayana in India, they have around 5,500 plus beds. So they started off from Karnataka. They started off from NICS Bangalore, and their approach has always been to develop center of excellence across various specialities in their hospital. So they will choose a particular location and a hospital, build it as a center of excellence in a particular speciality, like say for example cardiac or onco, and then all the nearby cases of that particular speciality they would want to serve at that particular location, rather than duplicating the manpower or infrastructure. So for example, their NICS Karnataka, in the Karnataka cluster, is a center of excellence in cardiac. Their Majumdar Shaw hospital in Karnataka cluster, which is again 627 bed, that's a center of excellence in onco and renal. And these two are the center of excellence which helps across all the 2000 beds which they have in the Karnataka cluster. Similarly, in eastern region, their RTIICS hospital in Calcutta is a center of excellence in cardiac, 613 beds. Raipur, they have developed it as a center of excellence in onco, and this entirely, these two center of excellence helps their 1000 bed capacity in the east region. In west, they have expanded recently in Mumbai so their approach over there has been to start with a childcare super speciality hospital. It is a new hospital since it started post 2016 itself. It has been ramping up and near to its EBITDA break-even levels. In the north cluster, they started two new projects post 2016. One is in Dharamshala, Delhi. Again, they have decided it's a 350 bed hospital which they want to focus for oncology, being the primary center of excellence over there. So it was famous for oncology. Now they are trying to add more specialities to it. In Gurgaon, they have a 211 bed hospital which they want to focus on international patients. Now overall, so their approach has been more towards creating clusters and having center of excellence of a particular specialty in that cluster. Their current expansion plans is something we are going to discuss in the next slide. But one good part about Narayana's model has been that they have always followed an asset-light model. So barring these two hospitals which they had pre-2007, all their other hospitals are leased, and they basically tie up with a charitable trust, government body, or a not-for-profit organization who invests in the land and building connected with the hospital. And as a result, their in cost per bed, which is there on their balance sheet, is very low, around 30 lakh rupees, versus 1 crore, 1.5 crore per bed as a cost for any other player who would have had similar facilities at the place where they have. That's about Narayana's India's business. But the other part is that when I look at their overall business, they have two parts. The 5,500, the 6,000 beds is what we discussed is the India business. They also have 110 bed hospital in Cayman Islands. Cayman Islands is a part of United Kingdom, but it is somewhere in between US and UK in the ocean territory. It's a small island, and now they did this investments in around 2018-2019. Right now they draw around 20% of their revenue from Cayman Islands, and this contributes 30% of their EBITDA business. Rest 80% of their revenue and 70% of their EBITDA is what comes from India business. India business we discussed in detail. I think their expansion mode is that it's not very clear, but they have said that they want to do brownfield expansion only, meaning they will expand in their Bangalore and Calcutta center of excellence or the nearby clusters where they already have some facilities, and it is going to be implemented over 2-3 years. So all these expansion is going to come gradually, say 300-400 bed additions every year, and at this on the Cayman Island their expansion is going to, there is a 50 bed expansion which they have planned, that is going to come somewhere in 24. By 24, the economics as guided by the management is that the overall project is going to take $100 million. So 800 crore of capex is planned for this investment. The revenue potential at scale is going to be around $100 million, and this business is going to yield 40% margin. So if this happens, then it implies a 25-30% ROCE. But one interesting thing, since we are discussing a point, is their business points out the difference in healthcare expenditure in India versus others, right? So take the cost per bed. Here, if I take the benchmark of 800 crore for 50 bed, it implies a 16 crore per bed cost in Cayman Island. This compares to around 1 crore per bed for a proper greenfield expansion in India. So the difference is 16 times between setting up a hospital bed in India versus Cayman Island. Similarly, RPOBs are also very different. In India, RPOB of Narayana is roughly around 30,000. The same case if I go for any other multi-speciality hospital might be 50,000. But if I look at RPOB for Cayman Island, it is roughly around $5,500 to $6,000, which is roughly around 4.8 to 5 lakh rupees. So 10 times of what India business offers. So that their business actually showcases the difference. My take on their Cayman Island is that it's a relatively low growth market. India obviously offers much better growth opportunities vis-a-vis Cayman Islands. So spending a lot on a lower growth region might not justify the same EBITDA multiples which we give to the India profitability and India business. So keep that in mind when you value Narayana. We're going to see it at the end of it. But that's how the things are planned. So we are also planning the bed expansion in Cayman Islands and subsequent revenue utilization from the incremental beds by FY25. So their current revenue is around 730 to 800 crore. That is going to grow up to around 1400 crore if everything goes as planned, and the mix of Cayman is going to simultaneously increase. Now when I look at Narayana, broadly this is the India business, this is the overall business outlook. So in terms of number of bed, from 23 to 25, not much beds in terms of number, 300-400 in India and 50 in Cayman Islands. On the occupancy side, I think the occupancy is going to remain at building at a similar level occupancy, because as you grow in the new hospitals in Cayman, etc., it is going to take some time for improving the occupancy. In terms of their overall RPOB, the RPOB should see around 5 to 6% of growth over 24-25 is what I build. In terms of margin, they are operating at around 21% margin in their 2Q numbers, and I believe that a fair estimate is going to be that they maintain this margin over the next 2-3 years. Execution is key. If they are not able to execute the improvement in margin which they have showcased in H1 FY23, then again the stock might surprise negatively. But till now they have been able to deliver well in the first half of the year. So all in all, I think at current price it trades at more around 16-17 times EBITDA and 28 times earnings on FY24. Similar to Fortis, so between Narayana and Fortis, I am inclined more toward Fortis. There is a legal case, but otherwise as a brand and as a whole chain, Fortis has much better profitability profile versus Narayana. Narayana summarizing, so there are good signs of margin improvement which they have shown in H1 FY23, which was missing for a long period of time earlier. Sustenance is going to be key. But the negatives are that I think that they have a lower visibility on capacity growth in the next 2-3 years. It's a very generic statement. We have to see the overall cost of expansion, the overall timeline of expansion, and see international growth. I think the potential of growth is lower in Cayman Islands. So investing more money there and the EBITDA generated out of that business might not receive the same weightage in terms of valuation vis-a-vis the India business. Now let's look at Apollo Hospitals. So Apollo is again one of the most well recognized brands. It was started by Dr. Pratap Reddy in 1983. When I look at Apollo, they have a revenue of around 14,000 crore, but they have three businesses within them. One is the hospitals business. The second one is their pharmacy business, Apollo Pharmacy Chains. The third is the others, which is 9% of the overall revenue. It has businesses like diagnostics, their primary clinics, etc. So all of them are still in a much early stages of their growth and cycle. Now when I look at the profitability mix, 70% of their profit comes from hospital. Their hospital runs at around 23% EBITDA margin. Their pharma business, obviously pharma business is more like a retail business. It's the margins in the pharma business is roughly around 8%, but it is a very low capex. It requires a very low capital intensive business vis-a-vis hospital, which has a very high capex requirement. Plus pharma business has a better growth profile than hospital business. So to that extent, this 8% is again one of the best in the class when we look at the pharmacy business itself. The segment has shown a lot of improvement in margin over the 4-5 years. One is that India's adjustment, but also as more number of your pharmacy unit matures, your margin profile improves. But beyond that, what contributes to loss is their Apollo 24/7, which has a burn rate of rupees 500 to 600 crore per year. We are going to discuss the three core businesses in detail in the coming slide, but I want to touch upon Apollo 24/7. Apollo 24/7 is the digital platform which encompasses all the healthcare needs in a single platform. So things like doctor consultation can be booked. What you can book out of is doctor consultation, right? You can book diagnostic tests, and you can place your pharmacy orders, right? Now all these three things, Apollo 24/7 acts as platform. What they do is that they source that business and then transfer it to the original department. So if there is a doctor consultation, then it gets transferred to the hospital unit of Apollo. If it's a diagnostic, it gets transferred to the diagnostics business of Apollo Diagnostics, the part of the others. If it's a pharma order, then it gets transferred to Apollo Pharmacy. What is the monetization model for Apollo 24/7? What they do is that they keep 10 to 15% of the GMV. It is basically the commission value. 10 to 15% of the GMV. GMV is the order ticket size in the first year from the customer which they refer to, and from year 2 onwards they keep a 2% of the GMV whichever that particular customer generates. So for example, if he has ordered a pharmacy bill of say 1,000 rupees in this year, then Apollo 24/7 is going to take a cut of around 100 to 150 rupees from Apollo Pharmacy, and the balance is then part of Apollo Pharmacy and its own P&L. And going forward, it is going to have 2% of whatever that customer spends on the Apollo Pharmacy business. So that's a broad model. But if I look at the numbers in FY21 to maybe H1 FY23, the business has been generating an annualized run rate of around 1,000 crore GMV today. That has grown significantly over the last 3 years thanks to COVID and the digital wave. But at the same point of the time, the business is right now burning around 500 crore of cash flows, which in my opinion is relatively much higher in their business model. And a slight disappointment with Apollo has been their execution in Apollo 24/7. Apollo has all what it takes to make it a great platform. They have a strong backend to support both in terms of doctors, pharmacies, and their diagnostics businesses. But yet I think their technology platform has been average. If someone uses Apollo 24/7, it is not very seamless to use. So to that extent, I am not very optimistic about the possibilities. This is going to be a business. You have cash flows to sustain the burn rate, but how this business pans out is something which needs to be watched out. Let's look at the Apollo Hospitals business itself. So Apollo Hospital has 44 owned hospitals and 5 operation and management contracts. It's a 9,400 bed hospital, 68% occupancy and 50,000 RPOB. It's a very well diversified revenue pool. So Tamil Nadu, which is region which is Chennai plus has 30% of the overall revenue. This is the core original from where they started. Their AP Telangana region is where they have Hyderabad plus region that contributes around 17% of the overall hospital revenue. Karnataka, which is Bangalore plus contributes 11% of their overall revenue. Other smaller areas like Navi Mumbai, Nasik, Bhubaneswar and Bilaspur, these 4 hospitals contributes 11% of the revenue. And then Apollo has a lot of JV and subsidiaries. For example, their Calcutta business Apollo, they have Apollo in Assam, they have in Delhi, which is Indraprasth Medical, they have in Ahmedabad, Indore, Lucknow. All these smaller subsidiary JV constitutes around 30% of the overall revenue. So it's a diversified mix. If I look at their matrix, their growth rate has not been, in terms of beds, has been average. We'll talk about the expansion plans going ahead, but I think what they have done and ensured is that they have maintained the overall occupancy level for most of the beds, and at the same time they have been very successful in improving the RPOB profile of the overall hospital. So from a 35,000 rupee RPOB in 2019, that stands more at 49,000 rupees RPOB, and because of that they saw a decent revenue growth, doubling from around 5,000 crore in 19 to roughly around 10,000 crore 9,000 crore expected in 23. When I look at overall 44 hospitals of Apollo, 29 fall in the mature categories, 14 in the new categories. In mature hospital, they make a 24% margin versus 18% margin in the newer hospitals. Proton is their cancer care specific hospital. Again, Proton treatment is one of the most costliest treatment. Not very few hospitals will be having it, which is why this one center has a lot of potential in terms of revenue, and margin can also improve from 29 to around 35 to 40% given the nature of the business. Obviously over time the RPOBs are higher, but that justifies the level of treatment which is provided on cancer care with the Proton facilities. So overall there are room to improve margins for Apollo. So their margins are currently around 25%. There is room for another 150 basis points expansion over the next 2-3 years. In terms of bed capacity expansion, they have announced 2,000 beds over 3 years. But again, large part of it is going to come in 25-26, mostly rather. So they have a 550 bed operation expansion going on in Gurgaon. They have a 500 bed expansion in OMR Chennai. In Bangalore, they have around 600 beds planned in 2 locations, and in Mumbai they have around 400 bed planned. But having said that, apart from maybe Gurgaon and Chennai, we have very limited understanding of the cost items and the timelines. So I'm assuming that most of this is going to happen after 24. In Apollo pharmacy business, it's one of the most well diversified. It has a very well diversified presence. It has around 5,000 pharmacies across India. And this business has been growing at around 20% CAGR. If I look at their revenue from FY18 to let's focus on the front end back end. Will come what only back end means, but their pharmacy count has improved from 3,000 to 5,000. Simultaneously, their revenue has grown at a 20% CAGR. Revenue per stall has increased from 1.2 to 1.6 crore, and their net of rental, their margins have been at around 6.6, which has shown a consistent improvement as more and more pharmacy units mature. Now, an important thing in Apollo to understand is that when I look at a pharmacy business, there are 2 parts to it. One is the retail store, which I see, and then there is a back end. backend is basically distribution and everything which is there in managing it. What Apollo has done, that Apollo owns 25, separated these two. He now owns 25% of the front end and 75% of and 100% of the backend business, right? And the arrangement on revenue and profit sharing is such that the front end keeps around 15% of the profit, while back end keeps around 85% of the business of profits. So effectively what Apollo owns in their pharmacy business is 85% of 100% of this 85% back end plus 25% of 15% front end, roughly around 89% of the overall revenue, which is what gets reflected in only back end number, and that is what gets accounted in their overall EBITDA number. They have had done a tie-up with Amazon. I think that needs to be looked at carefully, that could be a good lever for growth. They have tied up with Amazon for distribution of their pharmacy business. So it's a tie-up which has happened at the Apollo front end. So all the sharing of cost, etc., is going to happen at the front end pharmacy itself. Back end is going to see the growth in volume, which should benefit. This is what they mentioned in their recent call. I think the third part, which contributed 9% of the overall revenue, was their Apollo Health and Lifestyle business. What this has is a lot of smaller niche categories, and they have tried to develop somewhat sort of single specialty niche verticals for few of the growing segments. So for example, for diabetes, they have sugar clinics, they have dental clinics, they have around 250 primary clinics, which are more like near household clinics. They have Cradle, which is the birthing center for mother and child care. Spectra facility is in the infertility market. They have 1,220 diagnostic centers, Apollo Diagnostics. For kidney and renal area, they have around 85 dialysis centers. So they have tried to have a single specialty verticals across a lot of things. The way they disclose, I think diagnostics is the first part of the business, which roughly contributes around 1/3 of their overall others business. Then specialty care, which is the Cradle, child care, Spectra, and which is the fertility business. So infertility business. Infertility management business. So which is the other part that has around 1/3 of the revenue. And the third part is the primary clinics for sugar dialysis, dental clinics, etc. That forms around 1/3. All of them are in very initial stages. So their objective, so total revenue is around 1,300 crore in FY22. The FY23 slowdown is largely because of the COVID business in FY22 that went up, and that again came down in 23. But overall, their objective is to grow this business at fast pace and to maintain a 15% margin at an overall level. So that is the initial target. I think by FY24-25 they should be in a relatively better similar position as they have guided. In Apollo, I think one more question which always arises is that, so this was started by Dr. Pratap Reddy in 1983. He was one of the most famous cardiologists. But after that, currently the business is run by his 4 daughters. They have done a great job till now. But two things, none of them are from medical background. And the second part is that they all have very distributed responsibilities. So for example, Pritha Reddy manages the hospital business altogetherly. Sunita Reddy, she looks after the financial management, fundraising, investor relations for the Apollo hospitals. Third daughter, Shobha Kamini, she heads the Apollo pharmacy vertical, and she also heads the Apollo 24/7, which is their digital business. And Sangeeta Reddy, she basically heads the digital and the IT processes for the company, and at the same time she manages the Apollo Health and Lifestyle verticals, diagnostics, cradles, verticals, etc. Now, great that they have been running this business in a very seamless way for the last decade, even though Dr. Pratap Reddy was there, but he has taken a back seat. But my question is that, what is the succession plan, right? Now, family owns around 30% of the overall business, and there are going to be there are around 10 grandsons, granddaughters after these 4, who decides to run the business, how the split is going to happen, that I think remains a question. And for me, it's a very big question, given the intensity of running a hospital business. There is no major professional which one can highlight in Apollo who would have that lead itself. All in all, when I look at Apollo hospitals, clearly my hospital business revenue, I expect it to grow at around 15 to 20%. Their pharmacy business can grow at 15 to 20%. I think there is increasing competition, but they have a very strong brand. And online players, as the liquidity funding becomes tighter, Apollo Pharmacy position strengthens over time. In terms of margin and the other businesses, the diagnostic and all, they might grow at a faster pace post over FY24, but FY23 it might be a flattish year as the COVID business normalizes. Net, I think their hospital margins, I expect it to increase from 23 to 26%. Pharmacy margins expect to be flat, and on the others, they might do a 15% margin by the end of FY24. And what I build in is roughly around 600 to 800 crore of cost in 24/7. The costs have surprised negatively because it has increased versus what the initial expectation was. But net, when I look at overall EBITDA, so for Apollo hospitals by FY24, their business can do around 2500 crore EBITDA, and at current price, it implies a 27 times EBITDA and 50 times P. Frankly, I believe that people value Apollo 24/7 separately, but till now I have not been very convinced of their execution at Apollo 24/7. So rather than valuing it separately, what I will look at is what I am paying for the overall EBITDA, because Apollo 24 is effectively helping you to source businesses in most of the other regions. So summarizing Apollo, it's a strong brand, well diversified geographically, which is a very big positive. Two negatives: one is the succession planning, which is uncertain, and 24/7 execution has been average. Valuations are rich at 50 times 24 earning, and maybe 27 times EBITDA. So for a very similar growth profile versus the other hospitals. So for me, it's avoid at this point of time. Now we come to the fourth hospital, KIMS. It's Krishna Institutes of Medical Sciences. It was started by Dr. Bhaskar Rao Bulinani, right? And they started off with this Secunderabad 1000-bed hospital. So out of that 4,000 bed which they have today, around 1000 bed is something which is there in this particular flagship hospital. It is one of the most renowned hospital in Hyderabad regions. This along with Kundapur, which were the two original units, they have around 1000 bed operational capacity, high ARPOBs 48,000, and very rich margins of around 30%. The other part in Telangana is Sunshine Hospital, which has 3 units: Paradise Circle, Gachibowli, and Karimnagar. This Sunshine Hospital is what they have acquired in 4Q FY22, and it's a business chain in Telangana itself. It's a 3 hospital unit chain. They have around 602 bed. Largely most of it is operationalized, but their occupancies is very low and their ARPOBs is very high. The reason this was because of orthopedic focus. So a good part of their business, I don't remember the exact number, but for 35-40% of the business used to come from orthopedic, which is why the characteristics were such. But now what they have a lot of levers for KIMS to improve the margin profile and occupancy in these hospitals. We are going to discuss that in the next slide, but this is the other part. So in core Telangana and Sunshine, so core Telangana contributes 50% of the overall revenue and 60% of the overall EBITDA. Sunshine Hospital today constitutes 20% revenue and 15% of the overall EBITDA. In Andhra Pradesh, they have expanded over the last few years through the doctor partnership model. An important thing to mention here is that KIMS has followed a very unique approach of going and tying up with the local hospital in that local doctor in that particular region. So they enter into a joint venture. Advantage to the doctor is that he gets the capital advantage, he gets the experience of running a hospital, which KIMS has. For KIMS, what it ensures is that having a local doctor ensures a much easier fulfillment of the occupancy and the footfalls, and that is what they had followed in Andhra Pradesh in many of the hospitals. It's right now around 1870, 1880 bed altogether across the various regions, running at a good occupancy level. The ARPOBs are lower, it being a tier 2, tier 3 regions mostly, but they maintain a healthy 25% EBITDA margin. Recently, they have bought Nagpur. It has happened in FY23 itself. They have bought 51% stake in the Nagpur hospital. The economics of the hospital is not great, but they have got it at a cheap valuation, and if they turn it around, then it might turn out to be a very good deal. So it's a 334 bed hospital running at 72% occupancy, but their ARPOBs are very low, 28,700. I think surgical revenue is much lower, and they operate at around 10% margins. It today contributes a very limited percentage to the overall profitability. That's a landscape of LIMS, the KIMS. Now, it's just the same summary which we discussed in the one previous slide. I think what I want to highlight here are the margin of improvement in Sunshine and Nagpur hospitals. So in Sunshine Hospital, out of the 3 units, they are trying to improve the margins from 18 to 25, 30% over the next 2 to 3 years through these 2 initiatives. One is their Gachibowli hospital. They are now trying to replace the older doctors which were at a very high cost to the new ones, and also they are adding more specialities beyond orthopedic to make it a more attractive multi-speciality unit. And in their Begumpet facilities, what they are doing is that they are shifting the hospital to a new and larger premises. The shifting is going to complete by December 22, and then it's going to take another 6 to 8 months for them to bring in doctors. But by shifting to the new and larger place, that is also a place where they want to expand margins and take it to 25%, 30% level, where then mature hospitals in Hyderabad operate at. So that is the scope in Sunshine. In Nagpur, clearly the first is to increase the ARPOB, and that can happen by increasing the mix of surgical revenue. And gradually, as you increase the ARPOB and the surgical revenue, your margin should expect to improve. So this expectation is by management is to turn it around by FY24 end. In terms of expansion plans, what KIMS follows is a very contiguous plan. So they have aspiration to expand in Bangalore. They have nearer to the West Andhra Pradesh. They have aspirations to expand in the Chennai region. They have aspirations to expand in the eastern part in, say, Orissa, Bhubaneswar, which is near to their Vizag units, etc. They have possibilities to expand in the central region and in the western region. So they try to expand within the circle. Right now, what is more under the realms of certainty is the Bangalore hospital. So they have bought a shopping mall for 120 crore, and they want to convert it to a 400 bed hospital. It will take another 250-300 crore of investment towards equipment, refurbishing and rebuilding it, but it is expected to commence by the end of FY24. So this will be a addition of 350-400 bed. Maybe initially they start with around 300 beds. The second expansion, which is very likely to come near term, is the Nasik hospital. So where they have partnered with Dr. Raj Nagarkar from Manvata Hospital. He is one of the famous oncologists in that region. They want to open a 325 bed multi-speciality hospital. A lot of their work is completed, and it is going to be operational by FY24. So these are the two. It's a 325 bed hospital. So around 600 bed expansion in the next 2 years. The other expansion which they have planned is in the existing regions. So they have around 500 bed expansion planned in Kondapur. It is there in Telangana. Their Kondapur facility is full with occupancy, so there is a need to, it's going to be a brownfield expansion. It will not take much time to fill in that occupancy level, and beyond that they have aspirations to expand in Vizag and Anantapur, but those are things which will come slightly later. All in all, this is one hospital which has a very fast growth aspiration. So their overall capacity expansion has been there, and they have been doing well. If executed well, they will be able to actually maintain the occupancy levels. The increase which we are seeing is because the turnaround in the Nagpur facility, turnaround in the Sunshine hospitals, So there is scope to improve the occupancy. RPOBs, I have tried to limit the growth because their Sunshine RPOB is 60,000 because of the high orthopedic mix. If that changes and occupancy improves, Sunshine RPOB might go down, but on a blended basis, they can still do a 3 to 4% RPOB increase. On the margins part, they used to be at 30% in FY22. Because of a lot of acquisitions, it has gone down to 25. Over time, they want to expand this 25 to more around 25 to 30% range, which is the mature hospital range. But being conservative because of the new expansion, I am building a 24% margin for KIMS over the recent period. So at current valuation, KIMS trades at around 35 times PE and 23 times EBITDA, which I think is fairly valuing for whatever growth they are promising, but it leaves little room for disappointment. So to that extent, I'll be slightly cautious, but it's a good hospital, good asset, and definitely a worth buy on if you get at a good price. A positive, strong execution track record. The doctor partnership model helps them expand in tier 2-3 cities, and it is unique, and they have a very good execution track record in both growth as well as maintaining the margins. So to that extent, it's one of the better assets in the multi-speciality space. So that's the end to the part 5th. We discussed about the 4 hospitals, their landscaping, the pluses and the minuses. In the next part, it's going to be very interesting, guys. We are going to discuss about Healthcare Global, which is a cancer specific hospital. Also, we are going to discuss about Rainbow, which is a childcare specialist. And then we are going to discuss about the stock preferences. We are going to cover up most of the hospitals which we discussed. So great. Stay tuned. Thanks a lot for watching. Hi friends, so I come to an end to this part of my presentation, and like hospitals, I wish to cover more number of sectors over time. I've done a similar work on cement industry. The link to that is in the description below. Would love to hear your feedback and any other sector you want me to cover. But have a great day. Thank you.